So now when we turn a bit more to the consumer, the jobs, salaries, wages, this is a way to kind of connect the previous segment. When we look at, when we looked at homes, when we looked at the cost of living, mortgages, forbearance, well, forbearance kept consumer balance sheets healthy. So when you look at how forbearance has increased and you look at the 90-day delinquency, it's come down, but look at 30 and 90-day on the mortgage servicing side, you can see that elevated. And that's when we use that heat map that we talked about in the last segment to really highlight it and tie it back to, look, even though things look better, it's still, there is going to be a big problem in a lot of key areas when we see the lifting of the moratorium on foreclosures and bankruptcy, foreclosures and evictions. So this is going to be something to watch, where as that expires, do people rush to then make some of these payments to avoid being kicked out of their homes? But when we talk about income growth, we really want to look at what is the actual median income over that time period, because you can see from the 70s on, we've really flatlined. And in last week's segment, we talked about how there has been more equity issuance, where there's a mixture of not only salary, wages, but also equity in the company, which helps close some of that gap. But you can still see that gap is still very open and problematic. And we still have yet to close that gap. And this is, again, going only through 2019. And we've seen it only get worse. It started to recover, don't get me wrong, it has started to recover in 2021, but we're still well off the pace that we should be, and again, still not keeping pace with that inflationary pressure point. So then when we look at that rebalancing act, like what is that rebalancing shift? And Matthew Klein had this on Twitter. He has a Substack, which I highly recommend, and he wrote a great book about trade wars and how it becomes class warfare, because there is a lot of different factors that come into this. And I think this is a very good backdrop of line workers versus supervisors, because what have we seen so far? We know that there has been some increase in wages, but as we've been saying, it's at the lowest level of individuals who are getting some of those percentage increases. Instead, it's when you look at the supervisor, and this is what we've talked about with companies taking away responsibilities, P&L responsibility, trying to use more machine learning and other types of means of adjusting or simplifying some of their job responsibility. You're just not seeing that payment. You're not getting compensated as a supervisor. And what are supervisors? They're usually salaried. They're usually paid more. That's where you start to get into that medium to higher income level, where you have, or you're supposed to have, more of that disposable income or discretionary cash. And you're just not getting that, because the lower wage income is really going to just, again, living expenses. Typically they're living paycheck to paycheck. So they're not really the ones putting out that disposable income, that discretionary cash. It's the supervisor side, and we're just not seeing that. And it's really broken down much earlier. That COVID, again, was a problem. I'm not saying it wasn't, but you can see that deviated much sooner. And we started to see that, which is one of the reasons why we've talked about why we were more bearish in 2019 and how you've seen this carry forward. And this is just another example of it. So then when we look at, what is happening in terms of rapid increases in the average wage. So the median wage growth. So when we look at the wage growth, you can see on how it dips, and it's just starting to recover with the employment rate. So if you think about jobs being as plentiful as they are, you would assume that there's more competition for wages. But you're just not seeing that median wage growth, because we're looking at the median wage growth. We're looking at all the different levels. And when you look at the highest level continuing to weaken, medium income continuing to weaken, bottom level getting better, it's still averaging out to something, or on the median side, not working out to something that is showing some real growth. And especially as the employment rate has recovered, we never saw that real dip, but we haven't seen that bounce back either. So then when we look at the average hourly earnings, they're up 4% year over year versus the estimate of 3.9%, because you're starting to see that, again, the average hourly work is moving higher, but it's that who is getting the money and at what level and at what percentage, because again, 4% of $15 versus 4% of $300,000 is a very different number when you break it out into its pieces. So then when we look at the average hourly earnings for production and non-supervisory workers, this is again pointing to where it is. So this is looking at leisure and hospitality. So as a sector, they're adding jobs, 3 million annualized gain in wages for for non-supervisory workers at 21.7%. So we're seeing an increase. Obviously, a lot of hiring has come down on a percentage level, and you've seen them increase wages, and obviously it's come back from their high of about 27% to 21.7%. So you're still seeing those average hourly earnings go up, but it's bifurcated, and there's a certain amount of, obviously, the cost of living is up, and how is that managing that additional cost of living? So then when we look at the small business owner and how the small business owner is looking at this, small business optimism reversed in July to 99.7 from an estimate of 102. Net percent of firms expecting better economy fell to only 20%. Sales expectations were weaker, and supply chain issues still weighing on business activity. So you're seeing that people are more concerned. And it comes down to inflation, prices going up, supply chain, lack of finding employees. All of this is leading to this concern about what are those conditions going to look like, because coming full circle back to what we talked about in segment 2, if I can't pass through additional pricing and my costs are going up, if I have to pay more to hire someone, well, how can I be optimistic? Like, I'm concerned about my bottom line, keeping the business afloat, and this is things that are weighing on general business optimism, which is why employment change is getting worse, because they can't hire new employees, especially when you look at small business compensation plans index. So compensation is going up, but they're sitting there and saying, I can't afford to hire someone new, so I'll try to pay the people that are currently working for me more and have them work more hours to try to offset the fact that I just can't afford to hire new individuals. Again, capping some of that growth in jobs. So then when you look at small business optimism on raising prices, all-time high, inventory satisfactory. So the further up it goes, the less satisfied they are. So you have raising prices at 46%, inventories at all-time lows. And again, how can you spend CapEx? So if we think about GDP as the consumer, government, investment, and then exports minus imports or trade, CapEx is investment. Like you're seeing the companies are telling you, we can't invest because we have to worry so much about our rising costs. We don't have the money for CapEx expansion. And you can see that has been a common thread since 2018, again, leading to why we were concerned in 2019, why we were concerned into 2020, and we still haven't seen anything really adjust in 2021. So then, but when you look at jobs, I mean, this is looking at U.S. job openings by industry is at an all-time high. There are more jobs, essentially for every 2 jobs, there is 1 person available. So, I mean, you would expect this to be moving at gangbusters rates, but they're just not seeing it. And it comes down to, again, these pressure points that we continue to highlight, and the data as it continues to come out is supporting our thesis for where a lot of this is, a lot of these problems. But when you look at new record for small business job openings, so job openings at small businesses, 49% of firms surveyed had job openings in July, up 3% from last month, and the highest since 1986. 27% plan to raise compensation in the next 3 months, not a record, but the highest since December of '89. They're trying everything that they can, but there's that bifurcation of trying and then actually able to do it, which is why there's that concern about business the conditions of the optimism index as these pressure points continue to offset some of the growth that they might see, additional sales, because there's a lot of these pressure points throughout the system. But when you look at disposable personal income in nominal dollars falling back closer to where we were, again, still higher than pre-COVID, but still coming back down, and the U.S. trade goods trade balance. So look at the U.S. trade balance. Look at that bifurcation, those problems that remain in the system. This is where we're beholden to the international market. So as personal income comes down and we have to buy more and more and more from the international market, that's, again, leading to price increases, and that's going to take down some of this disposable personal income because your living expenses are just going to cost more. And that's why we start to look at what is some of that normalcy and some of those different side pieces of that trade balance, and how it comes down to, again, volume versus value. Because volume can stay the same, and we know it's not. Volume is going up, but the value is also increasing, which is just making this trade balance worse and worse. And this is when we look at the average hourly earnings of so this is the leisure and hospitality, exactly what we were talking about with this move up. But this is looking at it not as a percentage of growth, but as dollars per hour. So here you can see that we're at about $16.50 or so. So again, this is great. People at the lowest level are getting more money, but how much does it cost to spend to live? And again, that's where you're getting some of this offset. So yes, they're not going into further debt, but they're also they don't have that additional disposable income. It's just going to living expenses. What happens if they have back rent, if they owe the mortgage company something to make up for everything, which again is leading to those problems. And this is just looking at the trade balance going back to 1992. You can see that it's at its worst ever, or at least since 1992, giving you an idea that we're still going to import pricing. We're still going to import inflation, and that's what we've shown time and time again with PPIs going up. As we said in segments 1 and 2, the amount of pressure on the supply chain, containers, shipping, you have it. That's where those pressure mounts. But the announced hiring plans have continued to slow. So they're still hiring. They've still been announced, but you can see how it's shrinking as states ending augmented benefits and states not ending augmented benefits. Mind you, these expire. All of them expire at the beginning of September. So you're going to see people forced back into the office, and it's going to be interesting to see how they respond and if we get any additional announced hiring. Now, where is that supply, the labor supply bottleneck? So when we look at manufacturing, construction have seen the biggest declines in hiring relative to job openings, followed by business services, state and local governments. Retail hiring is closest to pre-pandemic norms. So when you look at just what is hiring, so when you look January 2018 to Feb 2020, so pre-COVID, construction hiring, you were at 1.4. But when you go Q1 now into Q2, you can see that there's been this natural degradation of how are you able to hire and how things continue to get worse on that labor supply bottleneck. That's wrong, can't afford them, too expensive, don't have the skills, you have to train them, less productive, so why are you going to pay them more? Plus, there's a lot of people that are unemployed, so why am I going to, I can be picky too on the company side, trying to get the best value, which just means best skill for the lowest cost. So again, these are things that are showing those bottlenecks. But let's look at what has happened so far. So better than expected July non-farm payrolls at 943,000 versus an estimate of 858. So you can see that, again, trying to get back to that check mark, still 943,000, 146.82 million payrolls in total. So again, starting to get back to that normalcy. But when you compare it to the pre-COVID level, you get an idea that as we go forward in time, it's going to get harder and harder to kind of bridge that gap. Now, as we've talked about, when you take away some of the seasonality, like when you look at July, taking away seasonality, it was actually not a great number because you actually had a big hiring of teachers, you had rehiring on the government side, so state and local governments made up a big chunk of that. And then the counterpoint to that is, but in June, if you used unseasonal, they were better than expected. So you can try to spin things bullish or bearish in any way you want. We try to be agnostic and look at the data as it is. So that's just highlighting that there are ways to pivot that. But again, these are things that we like to look at in terms of pre-COVID versus where we are today. So then when we look at leisure and hospitality, this is what we were talking about with the state and local government on the last 2 months being the biggest increase, which is normal when we come back, get closer to school, hiring back. So that's where the surprise really came from. So some of this is noise related to seasonal adjustments. Teacher hiring didn't follow the usual pattern last year. The total jobs figure, therefore, was distorted to the upside, but it's still good. It's still positive. We're still moving in the right direction. And you could say the complete opposite in June, where June was actually better than expected if you used unseasonal versus seasonal. So again, it starts to average out when you're looking at those different levels. And on the other side, you're seeing the quit rate is increasing and layoffs are decreasing. And think about why people would be quitting. So you're sitting there, you have a salary that is locked in from when you started with maybe some small increases over time, but your prices are going up and they're not willing to give you a wage adjustment or living cost adjustment. So go find a new job. There's enough jobs out there. And from the employer's perspective, would you rather hire someone who's been working, who active will be productive very quickly because they haven't been sitting at home for 27 plus weeks. They've been in the industry, in the market, and they just want more money. So maybe it makes sense to do that, and that's what we're continuing to see, and this is something that is being shown here. But the beverage curve is so broken that it's just funny to see, because when you look at the unemployment rate that blew out during COVID, but job openings never died. They just stayed there. And now job openings have continued to grow as the unemployment rate has fallen. And just look at how crazy this is looking at 2001 to 2007, 2009. It is a very unique period right now. And the question is, is it easier to post jobs? And that's why we have it. Does the gig economy make it easy, skew those job openings? Because does each gig count for a job, even though it may only take you a couple of weeks, maybe a day? How is that? And I don't know. And if you have the answer, I'd love to have that conversation, because is this why some of these job opening numbers look so egregious or so elevated? Because it's just being calculated in a way that doesn't account for how jobs are being posted today versus previous years. So then when we look at the labor force participation rate, 55 and older continues to fall. Again, that increase in retirements, early retirements, which will also pull down some of these individuals that were getting paid top dollar because they've been in the same position. Maybe they took the job at the age of 40 and retired at the age of 66. You're going to have that. So when you hire someone back at the age of 45, you're not going to pay them what you were paying the guy at 65. You're going to pay them maybe what you were paying that individual at 50, or 47, because of just inflation, some of that bump. So that's going to also bring down some of that net income, which can also skew things. And then this chart just shows what we were talking about of adjusted and unadjusted. Because when we look at unadjusted in June, it was better. And then when we look at unadjusted in July, it was worse. It's each to their own. So again, this is why we look at things on the seasonally adjusted, because when you take the seasonally adjusted, you're actually much worse than the not seasonally adjusted. So that's why I kind of throw out some of that argument, even though I like to let it be known this is what's being said. This is some of those counterpoints, but it's just something that's in the lexicon right now. And then the average hourly work week. Average weekly hours have come down a bit, but you can still see they're elevated. Again, speaking to people working a bit longer for just because they don't have the ability to hire. So then when you look at that quit rate, it's really, speaking to the quits in general, it's really the same versus 2021. But when you look at where it's accelerating, manufacturing, leisure and hospitality, retail, trade, professional and business services, well, if I'm locked in at $15 an hour and I know I can go across the street and get $16.50, am I going to stay? No, I'm going to leave and go there and get an interview for that job. So that's where you're seeing some of these quit rates as people try to capture that better rate if they're locked in. at a lower rate that they may not want. So then when you look at the U.S. labor market recovery picks up in July, but jobs remain well short of normal. Here's where you're like the realistic versus the official. Realistic looking at participation rate, trying to get closer to what that real number actually is. But then when you look at actual employment versus projected, you get an idea of kind of where we sit, 8 million jobs short, but the transition rate from unemployed to employed versus job openings is massive. July 2021 transition rate of 9.7% below expectations, 917,000 fewer employed people. So again, this is the conundrum. Now, do we think we close this gap a bit more as we get and some of the excess unemployment expires? Yes. But again, these are some of those issues that we continue to see arise when we're looking at the data sets. Broader measures, alternative measures of the rate of unemployment. You can see plus part-time for economic reasons. No matter how you look at it, they are getting better in general, but they're also leveling off. And that's what we continue to see. And we don't see us getting back to normal even in 2021, but this is more of a 2022 event in general. And that's when we look at Homebase offers clues to that unadjusted payrolls, because you can see that on the unadjusted side, the change in Homebase employment. So this is what you're also starting to see is on that small business side, there's some of this pressure, which I think is going to show up more in August. Instead of talking about it in July, let's look at how August comes in. And that's where I think you see some of this catch up and some of the numbers coming under a bit additional pressure. But with looking at what normally would happen on inflation, output gap, neutral rate, typically the old Fed would be hiking. But when you look at the old Fed hiking and where we are today, you get an idea of just we're still 13 million people that are unemployed. And what does that mean? Well, you still have, it's better, but nice decline in the long-term unemployment, but 39.3% of unemployed have been without a job for 27 weeks. Still high in absolute terms, but off the peak from 43.4 in March. Again, these are additional pressure points that remain in the system because they're still coming down, but still well over where they should be, which is why when you look at unemployed workers per job openings, there's 1.1. So for essentially every job can get filled, but yet they're not. And again, more problems in how that's being looked at. But the hit to employment by industry sector, you see that leisure and hospitality had the biggest hit, so it should see the biggest reversal. So the question is, as some of that reversal normalizes, where are we going to shake out? And that's when we start to see that slowdown in hiring, which is why the pace has been aggressive, but it starts to peel off and slow. And then the core versus headline unemployment. If you distinguish between temporary and permanent layoffs, we've now undone all of the temporary unemployment, but none of the permanent job losses, which again speaks to some of those pressure points. And this is an interesting one when we're looking at, what are some of those pressure points on permanent job losses, because we've seen a lot of companies close. We've seen a lot of bankruptcies. So we still haven't started to make that up, which is going to be some of those pressures in general. And then the not in the labor force still remains over 100 million, which again leads to just when do they come back? And as we talked about with the 55 and older, some of these individuals will never come back. They'll just retire. But there's still going to be about 75 million or so, give or take, that will come back into the market, that will be incentivized to come back in. And this will take time to see. So now that we've done the deep dive in the U.S., we're going to pivot to Europe and go a little bit deeper into some of the European data and what are some of the impacts that we've seen, where still growing, but at a bit more of a muted pace than I think what was either expected or what we've seen so far this quarter.